In the last session, we talked about what we call it as the typical capital asset pricing model, that is to find out your expected return out there. We said that expected return can be found out by what do you call it as the risk free rate, that is the minimum amount of return that you have to get, or minimum amount of, or the return what a risk free asset gets, plus the risk factor of your investment measured in terms of beta into what is called as the market premium out there. And we said that this is what we call it as CAPM or capital asset pricing model. We said that to put it again, to reiterate in a simple term out there, the beta of investing in government security will be 0. So, what happens if beta is 0 in a government security out there, the minimum amount of return what they give for compensating for your inflation is what we call it as RF, or this is called as risk free rate. Why risk free? Because beta is 0, it is free of risk, so that is what it is. Now, I say that I am going to invest in an index out here. The beta of the index is 1 out here, and my index is giving me 12% return. That is what I took yesterday in the last class. If index is giving me 12%, that means it is, and my RF currently, let us say the RF currently is 4% out there, that means my market premium is 8% out there, that is 12 minus 4, 8%. So, if I go by the same thing, that means what? 4% risk free rate plus beta of the index is 1 into market premium 8%, that will be equal to exactly 12% out there. That will be equal to 12% out there, that will be equal to 12% out here. Now, I say the State Bank of India, for example, I am not exactly looking at the State Bank of India, let us look at a bank FD, let us look at a public sector bank FD. What is the risk factor? What will be the beta? Beta will be less than 1 obviously. Why? Because level of risk is lower than the index. So, how do we calculate beta? I have talked to you about covariance of your investment with the market divided by the variance of the market out there will give you what is beta. So, now let us assume that the beta of the FD of a bank is about 0.4, which is less than 1. Then what is the return you should get? You should minimum get my RF, that is I should minimum get 4%, plus market premium is 8%. So, plus let us say market premium out there, market premium is 8% out there, let us keep that 8%, multiplied by what is called as the beta of the investment out there. Now, I know the beta of the investment is 0.4, 0.4 into 8% plus 4% out there, that is going to that's going to be equal to this is 3.2 plus 4, that is about roughly about 7.2%. That is going to be about, if I say that is going to be about 7.2% is going to be what you call it as the expected return out there. That expected return is found from this, and this is what we call it as the CAPM out there, capital asset pricing model. There is another way of finding out what is the expected return in a market out there of an equity investment out there. And that is what we call it in this particular case as in this particular case as of valuing the equity out here. In this particular case, we are looking at what we call it as the is basically of looking at the, there is another way of looking at the expected return. Now imagine a stock which is giving you consistent dividend. Imagine a stock which is giving you consistent dividend. You are investing only in a dividend stock, it is giving you consistent dividend, it is not even giving you much of capital appreciation. Then what is the expected return? Expected return will nothing be but the, in this particular case, it will be what we call it as the dividend yield plus the expected growth rate in the dividend out. The dividend yield, you are getting the dividend yield, that is what we call it as a dividend discount model we use for valuation of equity. The dividend discount model which we use for valuation of equity, it will basically be your nothing but your dividend yield. What is dividend yield? Dividend you are going to get divided by the price at which you have purchased that equity plus what is called as the growth rate. In this particular case will basically give me what is the expected return out. That is what firm's dividend are expected to grow at a constant rate G. The price of the share of the stock P is basically what we call it as the price. Now this is basically the return that I am getting is the what is the second part of it, if you as you can the return what you are getting is the second part of it what we see. The price is nothing but dividend divided by the return minus the growth out there. The return is nothing but what is called as the expected return is nothing but the dividend yield plus what is called as the growth rate out there will give you what is called as your return, expected return of that. I have taken an example. The Wall Street Journal recently stated that the average dividend yield across all stocks in the Standard & Poor's S&P 500 index was about 2.1%. Suppose the numbers in the value line investment survey imply a 5-year growth rate of dividends for VL's industrial composite index of about 6% per year. What is it? Index yield, that is dividend divided by price, is 2.1%. Growth rate expected 6%. So what is it? 6 plus 2.1%, 8.1% is going to be the what do you call it in this particular case as the expected return in this particular case. That is all what happens out here. I am just moving to the next slide here. Now we talked about, I kept on talking about beta and beta and beta everywhere. Now what does this? Beta signifies risk, that also we said. It signifies risk is both systematic and unsystematic. Systematic, no, it's common across all stocks, that is macro variables. Unsystematic, specific, company specific. So what happens? Eliminated by diversification. Can be eliminated by diversification. So we are talking about these aspects out there. We are more and more going to talk about these unsystematic risk, not the systematic risk, because systematic risk we are not looking at elimination out there. We are going to talk only about the unsystematic risk portion of it. So that is what constitutes your beta in this case. That is what constitutes your beta in this particular case out there. So what happens? It is also, it's always impacted by what we call it as the business risk out there. That is where we diversify and we take care of it. We diversify and we take care of it, business risk out there. That is cyclicity of revenues, the operating leverage. What is the operating leverage? We will come to that in a couple of minutes from now, and also the cyclicity of revenues. For example, it might have, the revenue might be in a cycle out there. Look at your steel industry, look at cement. Normally these will have a lot of cyclicity in their operation, in their revenues and so on and so forth. Next is also the financial leverage, the level of borrowings, level of borrowings that the firm has, that can also determine beta. If the level of borrowing is extremely high, then what happens? The risk is going to be very high because you will have a lot of cash outflow because of interest payments. The debt burden will be huge. So what happens if a lot of money is paid out as interest to the equity holders, to the debt holders, what is the money left for the equity holders? Almost blob out there. So risk increases out there. That is what we talk about in this case, financial leverage. I have got some details about what you call it as cyclicity of revenues out here. I am not going to read out this slide. It is more going to, you can spend some time looking at this slide, not an issue. Highly cyclical will have higher betas, please note, because why? Risk is relatively higher. Non-cyclical industries is not the same as variability, that is, stocks with high standard deviations need not have higher betas out there. It can have a high standard deviation, that is, the variability can be high, but beta need not be very high, risk may not be very high, but variability can be high out there. I have given some examples out. Movie studios have revenue that are variable depending on whether there is a hit or a flop, but revenues may not be especially dependent on any business cycle. So betas need not be high. Risk is high, but it need not be on a business cycle. It is just on the performance of that particular movie out there or movie house. Now, what is operating leverage? We know that fixed costs don't change, variable cost increases with the level of output. Often you face a trade-off between fixed and variable cost. As volume increases, you want to commit for, idea of any business is to commit for lower and lower fixed cost. Why lower and lower fixed cost? Because even there is a downturn, even if there is a business cycle, down or fall in the business cycle, your impact is little less out there in the case. So normally companies opt for, idea is to keep the fixed cost as low as possible out there. For example, building own factory, outsourcing production can all have what you call it as lower fixed costs. In this case, firm with high fixed costs and low variable costs generally said to have high operating leverage. Firm with high fixed costs and low variable costs will have high leverage out there, because too much of fixed cost, that means too much of commitment to be made. If too much of commitment, then your borrowing is going to be high and naturally your leverage is also going to be high in this particular case out there. It magnifies the effect of cyclicity of firm revenue, especially if there is a cyclicity in the firm's revenues, this leverage basically magnifies out per se out there. I have got some more. This degree of operating leverage means it sort of measures how sensitive is a firm to the fixed cost out there, how sensitive it is to the fixed cost. More sensitive, higher is the operating leverage, higher is the beta. Less sensitive, lower is the leverage, so possibly lower beta and so on and so forth. We have talked about this dividend discount model approach. I have also got a small comparison between DDM and CAPM. In dividend discount model, all that I have to do is I know what is the dividend in year 1, dividend in year 2, dividend in year 3, and I will have that dividend out there, whatever is that dividend X and then X and then X out there. All I have to do is I will have to what you call it as I will have to discount these. Discount this using a particular rate, then I will have the value of the equity out there. If I know what are the dividends, all the future dividends I discount and add up. All the future dividends I discount at a particular rate and add up, and that is what gives me my dividend discount model. Very simple. Whereas the adjustment for risk is primarily, measurement of risk is primarily absent. The measurement of risk is undertaken by the amount of dividend that you are expecting, that sort of captures, that is expected to capture that risk also. Risk factor is expected to be captured by the level of dividend that you are basically going to garner or get out there. That is what happens in a dividend discount model. Whereas when you take CAPM, CAPM adjusts, explicitly adjusts for the risk. How? By beta. By beta, it explicitly adjusts for the risk, and it is applicable for companies that pay no dividends. Many of the companies don't pay dividends, they retain, they keep reinvesting out there. So, it is applicable even for cases where there are no dividends out there. Dividend discount model is only applicable where for the companies which pay steady dividends. As you can see what I am underlining. As you can see what I am underlining, it is suitable only for companies which pay steady dividends. It does not consider risk factor at all. The next aspect, we looked at equity. We looked at equity in terms of dividend discount model, we looked at equity in terms of CAPM, expected return, so on and so forth. We have some idea about beta and so on and so forth. Now, the next basic aspect, what I am going to focus on at this stage is more going to be on what we talk about. We talk about the next aspect, that is cost of debt. What is cost of equity? Cost of equity is expected return. Is cost of equity. Let me keep this in a corner. Now we come to what is called as cost of debt out there. Cost of debt is nothing but the interest that you pay. Interest you pay, that is all. Interest rate required on a new debt issuance. If there is a new debt, that is the interest rate that you have to pay is basically what we call it as the cost of debt. And we always adjust for the taxes out there, that is adjust for tax deductibility of interest expenditure, because debt interest has a tax shield out there, as I have indicated in one of the earlier cases. Debt interest is always pre-tax, so it will always have a tax shield out there. I have got some small example out here. For bonds, I said that small risk of default, and we will talk about the default part of it in a couple of minutes from now. Let us take up the example. Return manufacturing company issued about 100 million of debt with a 7% coupon. Coupon means interest rate. Well, the bonds were initially issued at par. Rising interest rates over the last 2 years have caused them to sell it at a discount. The yield on this bond is currently 8%. In order to finance expansion, RMC is considering another large issue of bond. What is the cost of the new debt? Simple. The cost of the new debt is 8%, because what is the prevailing market rate? The prevailing market rate of your company's debt, because given the risk profile of your company, the prevailing market rate of your company's debt is about 8% is the prevailing interest rate for the risk for a instrument which has similar risk profile. Let me rephrase it. The prevailing interest rate for an instrument which has similar risk profile as to your company. The prevailing interest rate for a instrument which has a similar risk profile after your company is about 8%. That is what yield indicates. So, what is the cost of new debt? The cost of new debt is nothing but 8% out there. That is what you can issue at. If the old bonds are selling at 8%, the new debt cannot sell lower at the lower yield out there. 7% is merely historical. So, if you are issuing for the historical, and often calls for embedded cost of the debt, that is okay. If you are issuing for the first time, yield on the prospective bond is the cost of debt. What is the expected yield out there on the cost of debt out there. Loans with commercial bank, borrowing rate is the cost of debt. The rate at which I borrow is the cost of debt. Yield is the expected yield. Expected yield on an instrument is the cost of debt out there. So, that is what we are ignoring, taxes so far and go ahead. Next I talk about preferred stock. Preferred stock have what is called as, there are stocks which are given preferred stock out there, preference shares. There are stocks which are given as preference shares. You are not equity, you do not have voting right. You are a preference shareholder, it comes next to the debt in terms of in terms of settlement at the rate of when dissolution, etc. That is after the debt. But you are assured of a fixed rate of return. And you are also assured of redemption at the end of a certain period out. Redemption, that is, the company will take back the shares, preference shares that is given to you, and give the face value to you at the end of a specified period. That is also possible in a preference shareholder. Preference shares pays constant dividend. I would say in perpetuity. I would say for the specified period of the preference share. So, when we say perpetuity, I mean every preference share is going to go on paying out there. That is what I mean. Similar to a bond, only difference between common stock is dividends on common stock are not constant over time. Dividend is a share in profit. Here, dividend is not a share in profit. Dividend is some kind of a assured return that you are going to get out there. Dividend does not depend on the volume of the profit what you make out there. Supposing a share of the preferred stock of Polytech is selling at 17.16 and pays a dividend for 1.5 per year. What is the yield? So, what is the yield? Yield is nothing but what is the selling price out there? 17.16. That is the denominator. What is the dividend? 1.5. So, what is your return? Return is about roughly about 8.7% is the kind of yield, and 8.7% is the cost of that preference share, because that is the expected return on the preference share as of today. So, 8.7% is the cost of the preference share out there. I have taken another example out here. So, now that we know what is the cost of equity, what is the cost of preference, what is the cost of debt, etc. So, what is the use of all this? A company, when it has, what do you call it as, capital. It has equity capital, it has debt capital, it has preferential capital. And that can be multiple kinds of debt. That can be secured debt, that can be in the form of bonds, that can be in the form of institutional debt, and so on out there. Ultimately, what is the objective? As I said in the first class, there is a cost for this, 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 and there is a cost for this also. What is the ultimate objective? Ultimate objective is to keep the cost low. How do you keep the cost low? You work on combination of these capitals. So, what are you looking at? You are looking at keeping the weighted average cost of capital low out there. That is the core objective what you are trying to look at. Keep the weighted average cost of capital low out there. So, what is this weighted average cost of capital? So, weighted average cost of capital, let us look at weighted average cost of capital. I have a slide, I will get to the slide a little more. I have in my capital structure, I have equity. When I say equity, I mean all the money belonging to the shareholder, the net worth. What is the percentage of equity to my total capital? What is the cost of my equity? What is the percentage of preference share to my total capital? What is the cost of my preference share? What is the debt of my percentage of debt to my total capital? What is the percentage? What is the what is the cost of debt? In this particular case, I say after tax cost of debt. What is this after tax cost of debt? We will come to that in a minute from now. Sir, you mentioned different types of debt. Yes, sure. Instead of this, you can say I am going to, instead of this can be in the form of what do you call it? I will say this can be, I will say D1 by TC into the cost of D1 plus D2, debt 2 into the total capital into the cost of D2 and so on and so forth. No problem. Instead of keeping this, you can write this out there in this particular case, different kinds of debt. Each debt has a different cost. And by doing this, we calculate what is called as WACC or weighted average cost of capital out there, or typically weighted average cost of capital. Now, why did I say after tax cost of debt? Why did I say after tax cost of debt out there? Now, let us look at, let us take an example and see. I have used this example prior many times, but let us look at it. Let us look at two companies A and B. A has what is called as equity, B has what do you call it as debt and equity. A has $100 equity, B has $60 equity, $40 debt, and this debt is at 10% out there. So total both the capital is 100. Now, my profit before depreciation, my profit before, let us not take depreciation, my profit before interest and tax is $20 for both. And my interest component in this case is 0, in this case is $4 because 10%. So, what happens? $20 out here, $16 out here, that is PBT, profit before tax. Assume my tax at 50% out there, my tax is at 50%, so $10 goes, $8 goes out here, and then what happens? My profit after tax or net income is $10 and $8 here. So, what is the cost of debt? You will say, sir, the cost of debt is 10%. But because you have taken debt, so what is the cost of debt? The cost of debt is said $4 or 10% out there. But please note that if you say what is the return on investment out here, the return on investment in this case is $10. My investment is $100. The return on investment in this case is $8 plus $4. My investment is $60 plus $40 out there. So, you will say, can I say that company A has a 10% return whereas company B has a 12% return out there? Well, no. Well, no. Why does company B have a 12% return? Because it has saved $2 on the interest of the debt out there. It has saved $2 on the interest of the debt out there. As you see out here, it has saved the $2 because on this $4, the interest that is they have paid, they are not paying taxes on that. So, because they are not paying taxes on that, they look more efficient. But in effect, what is the ROI for both? Return on investment. So, what do? I am looking at operations. I don't want to take the capital structure into consideration. So, what do? I knock off the effect of capital structure. That is what happens in this particular case. I said $4, 1 minus T, what do you pay? Plus $8 divided by 60 plus 40 or 40 plus 60, you will say 10% out there. So, what happens? The effect of what do you call it as the taxes, the tax shield, I am knocking off in this. The effect of tax shield I am knocking off in this particular case out there. That is what we do. So, now coming back here, coming back here, when I talked about WACC out here, I am taking out the after tax cost of debt, that is the tax shield what you are going to get out there because your capital, you are using the capital structure of debt out here. I am knocking it off. What is the after tax cost of debt? Supposing I did not have debt as a component in the capital structure, I had only equity and preference. Then what happens? The tax would have kicked in the process out there. because I have debt on the capital structure, I am saving on tax out here. So, I am knocking off the cost of the cost of debt, the after tax cost of debt, the net cost of debt. Supposing I did not have debt at all in my firm, then what would have happened? I would have paid tax on this $4 also. I would have paid tax on this $4 also. Because I have debt in the firm, I am not paying some taxes out there because it has a tax sheet. So, when I want to find out what is the cost of capital out there, the cost of capital out here in this particular case should basically be, I'm looking at two companies out here. I'm looking at the cost of capital for both. The cost of capital for both is basically after tax cost of capital for both is almost the same in this particular case out here. So, it is in this case cost of capital. Let us come back. Now, let us go back to this. We say that expected return is equal to cost of capital, or I won't say cost of capital, let us say expected return is basically going to be the discounting rate, or what do you call it as our asset or cost. The total expected return on investment in this case is only 10% out here, in this case is at 12%. Because you have debt in the firm, does your return, expected return increase by 2%, expected return in go to 12% out there? Need not be. So, what happens? In this particular case, that is happening because purely because you are avoiding taxes on this, you are not paying taxes. I wouldn't say avoiding, you are having a benefit of tax on that. So, we want to nullify that effect. When we want to nullify that effect, that is when we will know the cost of capital. So, what do? We will say nullify that effect of after tax cost of nullify the effect of taxes on this cost of debt out there. So, this is what we call it as, what do you call it as, the weighted average cost of capital in this particular case out there, and that is basically what where we use as this is what we finished, and this is what we are going to. So, we next go towards what we call it as the weighted average cost of capital. What is this? In this particular case, they have used different notations, S and B, B for debt and S for equity. That is all. S and B is an equity. I have used to include the preference, it is not, there is no preference out here. So, what happens? Your average cost of capital into, I want to remove that tax shield because that tax shield I am getting because of a capital structure decision out there. I am looking at what is your cost of capital without that. He might have a debt component in the capital structure, I may not have a debt component in the capital structure for the same business. I just want to know what is it. Say for example, in this example out here, if I say my expected return is the cost of capital out here, can B have a cost of capital of 12%? Can A have a cost of capital of 10%? Can it discount the returns that I am going to get in company B at 12%? Can it discount the returns that I am going to get in company A at 10%? No. Both are exactly the same entities. I am having a 12% here purely because of a tax advantage. So, I want to take out the tax advantage because the returns, if I am going to discount the future returns, I will have to discount and make both comparable. I will have to have the, and especially when both are comparable, I will have to have the same discounting rate. Because why same discounting rate? Because risk profile, everything is exactly similar. When risk profile, expected returns, everything is similar, I cannot have different discounting rates for it because then it is illogical. I will have to have the same discounting rate. How will you have the same discounting rate? You will have the same discounting rate because in this particular case it is higher purely because of the tax advantage. So, the moment I take out the tax advantage in this particular case, as I said did here, your return will become 10%, then your discounting rate in that particular case becomes 10% out there, and that is all what basically happens, and that is what we see out here, and that is how we arrive at what do you call it as the weighted average cost of capital. So, from here let us take an example on this. Example 5. Consider a firm whose debt has a market value of about 40 million and whose stock has a market value of 60 million, 3 million shares at $20, 3 into 20, 60. The firm pays 5% rate of interest on the new debt and has a beta of 1.41. The corporate taxes is 34%. Assume that the risk premium is on the market is 9.5% and your current treasury bill is 1.1%. What is WACC? That's all what they have asked. Let's go to the Excel sheet out here and let's try and see if we can solve it. What is the market value of the debt? 40 million. What is the market value of equity? 60 million. What is the weight of the debt out here? The weight of the debt in this particular case, obviously 0.4. Weight of equity, 0.6 out here. So, what is the cost of interest rate on new debt? The cost of new debt is about 5% out there. When I say 5% in this particular case, that is pre-tax cost of debt is 5% because they have given tax at 34%. So, what is the post-tax cost of debt? That is 5% into 1 minus the 34% out here, that is the taxes. That is basically the post-tax cost of debt in this case is only 3.3% out there because you are saving on taxes. What is the cost of equity? CAPM. What is the CAPM? Risk-free rate, current treasury bill 1% plus. What is the beta? Beta is 1.41 into what is the what do you call it as the risk premium, 9.5% out here. So, now what is going to be the beta, the equity is going to be 14.4% out there. What is the WACC in this particular case? Weighted average cost of capital. Weighted average cost of capital is nothing but, if I have to see this, it is 0.4 into the cost of debt plus 0.6 into 14.4, that is the cost of equity, and that is going to be giving you WACC. My WACC in this case is 9.96% out there. My WACC is 9.96% out there, and that is what we arrive at out there. Just multiply by the weights. That is now what is the cost of capital of this firm? The cost of capital of this firm is about 9.96% on an average. Weighted average cost of capital for this firm is 9.96%. Let us move back, go back to my presentation and let us go back to the next slide out there, next aspect out there.